Episode 200 of the TreppWire Podcast is sponsored by Commercial Real Estate Direct, the website that brings breaking news to professionals in commercial real estate. If you are looking to stay up to date on news, transactions, and CRE and CMBS data, visit crenews.com to sign up today. The TreppWire Podcast often sources our weekly stories from CRE Direct, so get ahead and subscribe today so you can dig into the stories we cover. This is TreppWire Week in Review for the week ending June 9th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week felt like being in the eye of a storm. Last week, investors were focused on debt ceiling negotiations, and next week there will be lots for analysts to digest. Another Fed decision, the May CPI report, and another wave of commercial real estate data that will give investors clues as to the state of the office market. And the economic data this week was mixed. Investors cheered and stocks soared after the June jobs number came in well above expectations. It was a Goldilocks report as the new data was accompanied by an uptick in the unemployment rate and a dip in hourly earnings. The economic data was not all positive this week, however. Factory orders for April and the ISM Services Purchasing Managers Index for May both came in light, and an OPEC cut in oil production pushed oil prices higher. Manus, it was a quiet week, maybe a little too quiet, so what is your take?
Haley, is that you? Lonnie, is that you? Of course, I'm making fun of the fact that New York was covered with fog and haze this week. If you were not in the New York area, that may sound a little odd, but the New York area on Wednesday in particular felt like you were in a Mad Max movie. The city turned both dark and orange at the same time. It looked like we were in about a 4-hour eclipse. For those that were following the news, you might remember that there were wildfires in Canada that were blowing wildfire smoke over the entire Northeast. So it made for a very interesting week in New York, a quite different week for those that were susceptible to asthma or other issues. I'm sure it was very uncomfortable. It kind of burned your eyes and burned your lungs. So that was kind of the New York headline this week. Economically, it was really a slow week, Haley. I think you nailed it on the head. On Friday, we saw that big jobs report that ended what was a very impactful and newsworthy week, especially with the debt ceiling deal getting done. The jobs report itself was really applauded by investors. Stocks shot up that day, particularly tech stocks. The unemployment rate going up. While nobody likes to see more people unemployed, the Goldilocks part of that is the fact that analysts think that that may put less pressure on the Fed to raise rates. Hourly wages falling, that too reduces some of the pressure on the Fed to raise rates. And the better than expected jobs number shows that the U.S. economy continues to chug along. So that was a great report earlier this week. Not terribly meaningful reports. The Purchasing Managers Index coming light, that was a disappointment. Durable goods orders, that was a disappointment. But all the real fireworks start next week with the Fed meeting, CPI, and other things. I think we get back to a news cycle that is very impactful for investors.
I would agree with you, Manus. I think the fireworks are going to be next week. You know, I was in New York this week and came out of the office after working all day and saw the orange sky. It was really a little bit different for someone from Texas coming into New York with all these buildings, sirens going off everywhere, which is just normal, 6 o'clock traffic, and an orange sky. So it was very interesting. The memes that were, spun off from that was really interesting. I liked the one that had Godzilla in the background with all the buildings from the meme on Twitter. But back in Texas now, where we just breathe in oil smoke and other things from refineries, no forest fire smoke. But my take on the unemployment numbers, I think it actually changes maybe the dynamic of what the Fed does next week. Heading into pod last week when we had the debt ceiling deal, I thought maybe the Fed would be, bullish or hawkish, and another 25 basis point hike was in line. I think now maybe that we've seen some teetering here, you might see them take a pause. And so I think that definitely maybe changes the dynamic there. Couple of other stories, some news. We've covered a lot about the banking distress over the last couple of months. There was a report that came out by the FDIC this week that highlighted Americans removed about $472 billion out of their bank accounts across the first quarter of this year. So it just starts to let us quantify, the impact of some of the bank runs. And we've talked a lot about the deposit issues at some of the lending institutions. $472 billion is a pretty big number. Wall Street Journal also highlighted this week that, in addition to, the national unemployment data showing some softening, California in particular has been pretty hard hit. They lead, they're second highest in the nation for state unemployment, which was 4.5% in April. And then Washington State was third at 4.3%, and Oregon was at 4%. They attribute most of the increase in unemployment across those states to the tech industry, which we've covered at length here on the pod in terms of layoffs, downsizing, et cetera, et cetera. So it seems like we're starting to see some cooling, at least on the employment side, which we haven't seen for some time, even though we would have expected to start seeing it at this point. So, maybe we're nearing, slowdown where the Fed, the markets, and everyone takes a deep breath and we kind of, enter into this new normal phase.
Yeah, I think I'm going to take the opposite side of that argument. I think probably 8 or 9 times out of 10, you and I see eye to eye on which way the wind is blowing. We certainly knew which way it was blowing this week in New York. It was blowing north to south with a lot of wildfires. I think you are on the majority for sure. I think 90% of analysts now believe that the Fed will take a timeout. I'm not so sure. If I were betting, I would say I'm going to bet on another 25 basis point hike. And it's going to be on the basis of 2 or 3 things. Number one, today the S&P 500 moved into bull market territory. It's now up 20% from its low. I think we've seen some nice growth in the tech market. We know that the Fed gets very nervous when the markets get frothy. They feel frothy to me now. And I think that's item number one that makes me think that a Fed rate hike could be in the cards. Number two, not only did Canada import smoke to us this week, they also imported a rate hike. They raised interest rates for the first time in 4 months, which was a surprise. It sent the markets lower midweek, and I think it set the precedent for the Fed also raising rates this week, that they would not be alone in continuing to push rates higher. And then certainly we saw higher interest rates in general this week. We saw Treasury rates from the 2-year to the 10-year all up 15 or 20 basis points from Friday to Thursday. And I think all 3 of those things, if I'm handicapping this thing, I think that there's probably more pressure on the Fed to raise than that 9-to-1 ratio of analysts voting for a pause would suggest. So we'll find out next week, and maybe we'll bet $1 on it, Lonnie. We'll see who gets it right.
Yeah, I think you might have convinced me to change my vote. Those are 3 solid reasons, I think, why the Fed maybe does take another 25 basis point action. So, we'll look forward to that and definitely give us something to talk about on next week's podcast.
I got to say, Lonnie, you brought up that thing about the banks. And I do kind of feel like, I think you said the number was something like 450 billion was taken out. I want to see that number adjusted for years when Taylor Swift is not touring. I want to know how much of that 450 billion was parents emptying their nest egg to send their 12-year-olds to see Taylor Swift at one of these stadiums. It seems like, that is the must-have ticket of the summer.
It's really remarkable. I mean, one, she fills up those stadiums, a couple of days at each stop. $20,000, $30,000 for some of these tickets. Like, people are paying it without even blinking an eye. So maybe the Fed should raise rates 50 basis points.
Yeah, I have to say that my kids will put her music on in the car sometimes. I don't mind listening. There's some of their music that I really don't enjoy listening, but I don't mind her music. And I hear that she puts on a terrific show. So I'm not sure I would say it's worth, $3,000 for a ticket, but it does seem like she gives her fans a lot of money's worth.
Are you a Swiftie, Haley?
I am not, but I'll give an early shout out to Jen on our team who is. So let's turn to the monthly payoff report, which is the report that shows the percentage of loans paying off at their maturity dates.
Yes, this is something we've been running since about 2010. During the great financial crisis, we had some clients come to us and ask us to start putting the statistic out every month. For people that have been in the industry a long time, you'll remember that in 2009, 10, 11, a lot of loans were reaching their maturity date and not paying off. There was a lot of extend and pretend, a lot of renegotiation, a lot of default. And for CMBS traders, the question was, is it worth my money to buy these interest-only bonds or these perhaps premium first pay bonds with the hope that these things extend for a year or two and I get some significant extra income? And we see this number ebb and flow quite a bit during strong economic times when properties are selling frequently and the velocity of money is high. You'll see 70 or 80% of the loans that reach the maturity date pay off in their balloon month. Certainly some pay off before their balloon month, but in slower economic times, that number really falls. During COVID, we saw some numbers that were only around 10%. Nobody was paying off their loans because nobody knew whether they could refinance. The markets were closed. So we saw those numbers really plummet. Right now, we're in a window where we're seeing about consistently 50% of the loans that get to their maturity date without having prepaid or defeased earlier, not making that balloon payment at this point, which is on the lowish side. It's not frighteningly low. I think on average, we run about 55 to 65% during normal times. I said earlier that sometimes we go higher than that. So it's not apocalyptic, but it's slower than normal. And it reflects the fact, in most likelihood, that office owners can't get dollars to refinance right now. So for those that follow that number, that think buying IOs and betting on the extension trade is probably not a bad bet right now.
Yeah, I think we'll see that number ebb and flow over the next couple of months, especially as we saw the delinquency number tick up here in May for office. To your point, Manus, I would suspect going forward, some of those office loans are going to continue to not be able to pay off. So something for us to keep an eye on, and it's good to have the historical perspective so we kind of know what that benchmark number should be. So if something falls way out of line, we'll be the first to be able to alert everybody and tell them, how the market's reacting.
So speaking of delinquencies, we saw a big trading alert this week on a hotel story that could really move the needle in terms of delinquency rates this summer.
Yes, thanks, Haley. That was a great reminder. This we've seen several times in the office market over the last 6 months, borrowers deciding that they're not going to support an asset anymore. They are going to look to transition the asset back to the lender. They're going to send the keys in, do a stipulated foreclosure. We haven't seen this a whole lot in the hotel market, but this one was kind of seismic this week. It came out via a press release. Haley picked it up very early on, I think it was Tuesday morning, sent me a text saying we should get on this right away. Dan McNamara on Twitter, who's a must follow on Twitter, also was circulating this. The story was that Park Hotels announced that it would stop paying debt service on its $700 million San Francisco hotel portfolio loan. They will not be making the June payment. The loan is backed by the 1900 key Hilton San Francisco Union Square and the 1000 key Hilton Park 55 San Francisco hotel. So about almost 3,000 hotel rooms in total in San Francisco represent the collateral. Host Park Hotels will not keep this current. In June, when they miss the payment, that loan will be in grace period, so it will not reflect in the June delinquency numbers. But unless they have a change of heart, this loan will go delinquent in July, and it's big enough that it would push the delinquency number for hotels up 80 basis points by itself and back above 5%. Now, certainly there'll be other moving pieces. It's not the only loan that will either go delinquent or cure, but it will have 80 basis points of upside pressure on the delinquency rate as a function of them throwing in the towel on this portfolio.
Yeah, this is a really interesting story, man. It's just given what we've seen in that market across the office sector. Now you throw in some hotels. I think it speaks to some of the quality of life issues that we've discussed here on the pod and how, they're starting to impact the broader CRE landscape. And, the reality is commercial real estate works in an ecosystem. You need to have business travelers, you need to have locals that feel safe, you need to have retail street level grocers, et cetera. They're able to provide for their local economies. And when those things start to fray, or they don't all contribute at the level that's needed for the market, then guess what? The other components of the market start to fade out as well. And so we've seen and detailed, pretty fully 20 or 21 national type credit tenants in the San Francisco market that have said they're going to close shop and move out on the retail side. We've talked at length about the office availability in those markets. And now you're seeing some hotel operators that are basically saying, we're not going to continue to service the debt. And so, it's interesting. It's noteworthy when it's one or two of those property sectors kind of on their own. It gets a little bit troublesome when you start seeing those things all working in tandem, because it's a lot harder to revitalize an area when you're talking about multiple asset classes and property types versus just trying to bring, office or retail or lodging on its own back. And so I think, your point of the 80 basis point, that can't be underweighted. That's a seismic shift for that one property to impact the rate that much. And the reality is we're not that far away from 4 or 5 other hotel operators or other, companies making a similar decision, and that number goes up significantly more. So something to definitely keep an eye on, even though it won't show up in the real data, like you said, until July if they don't make any additional payments.
That particular loan, maybe the big surprise was how long they held on for that. DSCR was negative in 2020, 2021, and remained negative in 2022. I used to, people talk about the strength of destination hotels over the last 18 months. I used to think of San Francisco as a big destination, desirable destination, right? When my wife and I would think about where to go, we'd say, hey, let's go to San Francisco for 4 or 5 days. Let's eat some great food. And I always love the topography out there, and you get into the Redwood Forest and Napa Valley and everything else. Certainly they have been left behind in the destination category. They troughed at a 13% occupancy rate in 2021, I believe, bounced up to 52% in 2022. But even with the 52%, that was not enough to flip the DSCR to even positive, let alone anywhere near 1.0x. But we'll have some more positive hotel stories before the pod is over.
Okay, Manus, why don't we just keep the ball rolling here and jump right into those positive stories for hotels?
Yes, we saw several positives. Two were undoubtedly positive, and one was, I would say kind of mixed. The first positive one was in Miami Beach. The Nautilus Hotel, a 250-key property, was acquired by Service Properties Trust. They paid $165 million for the asset, which comes out to almost $662,000 per key. The property's in the South Beach neighborhood. And, just that market remains extraordinarily strong. That South Beach market, great for hotels, Miami in general, terrific for offices, and, almost never a bad thing to say about Southeast Florida. It just continues to chug along. I'll mention one other. I would call this kind of a mixed screen. This comes from the Tampa Bay Business Journal, and the reporter there is Ashley Gerbal Kreitzer. I hope I pronounced that correctly. I think if I tried 3 or more times, I'd probably get the name right, but hopefully I'm close. She's reporting this week that the Westin Tampa Bay has been sold to Pyramid Global Hospitality. The sales price, $45 million. The seller was Nashville-based Castle Rock Asset Management. Why is this a mixed green and not a green shoot? Well, Castle Rock bought that particular asset for almost $58 million in 2019. So a little degradation of value in that particular sale. And Lonnie, let me throw you the big one.
Yeah, so our friend Peter Grant at the Wall Street Journal broke a really big story on Blackstone selling the JW Marriott San Antonio Hill Country Resort and Spa for a whopping $800 million. Second largest single asset hotel deal in the U.S. Since the pandemic. It was going to make for a pretty good profit for the folks at Blackstone on this deal. Looks like the buyer is going to be Ryman Hospitality. They've contracted to purchase the property. This hotel, if you're not familiar with it, is a really nice resort style property, 1,000 rooms, spa, multiple golf courses. almost 300,000 square foot of meeting space. And so Ryman, which is a Nashville-based REIT, which specializes in these types of assets, is going to take the property and feels like there's still upside potential with the asset. And so really stable market, definitely one of the top visited or stayed at hotels in the Texas market. It's exciting to see. Coming out of the pandemic, we didn't know what hotels were going to look like post-pandemic. And I think this is a really good sign for the marketplace to see almost $1 billion sale for a large-scale convention hotel down in the Lone Star State.
I'm going to take a detour here. This just kind of popped into my head, and maybe Haley will leave it on the cutting room floor. We'll see what happens with this. But the idea of a luxury hotel just brought to mind this week that my wife finally went out and shelled out for some of those really high-end sheets, the kind that they call them like the 100 thread or the 100 count things. They're supposed to come from like, the Giza area of Egypt or something like that. And I got to say, they're just not much better than the Target sheets. Like I expected to just wake up like 8 times happier the next day, based on what you hear on the radio and TV. Like I thought I'm going to wake up a different person, like a little less cranky, a little less need of that first cup of coffee. And it was just okay. I don't know. I just thought about this really luxury Texas hotel, and it made me think, of treating myself to spa treatments and a massage and everything else. And then I thought, I just did that this weekend. It just wasn't that good.
Yeah, I'm no sheet expert, but I think the bigger the number, the better the quality or something like that. And so I'm with you, Manus. I can't profess on the pod today to know if really fancy sheets would improve my life, but at this point, based on your experience, I would suggest it probably wouldn't.
So sticking to property type stories, let's look at office. I think we had a few green shoots this week, but mostly we're seeing more and more crabgrass.
Let's start with the green shoots. I got 3 of those. We put a trading alert out earlier this week. The 300 Park Avenue loan, which is a nearly $500 million CMBS loan, was extended. The property contains almost 800,000 square feet in Midtown Manhattan. It backs a 2013 single asset deal. The loan was scheduled to mature in August of this year. The property was once the headquarters of Colgate-Palmolive. Occupancy fell from 99% in 2018 to 75% in 2020. But the article says now that the owners, Tishman Speyer, have bumped occupancy back to 97%. So momentum is pointing the right way. That loan has been extended. And I think this is a really nice segue from what we saw last week with the Seagram's building. Similar story, big loan, Midtown Manhattan, not a brand new building by any means, built in the 60s probably, enormous amount of space. Occupancy had dipped below 80% in each case. Owners leaned in, rebuilt the tenant base, and even though a maturity was coming and the opportunity may have been there to punt, they went to the special servicer, negotiated an extension, and they, now have another year to continue to wait for more favorable times to get financing to recapitalize this property. So what do you think, Lonnie? That's a green shoot by any measure.
Yeah, definitely. Because I think if you had looked at this one 6 months ago, I would have said it would have been questionable as to whether or not they could get an extension. The occupancy was really low. NOI was about half of what it had been at origination. This property had some struggles coming out of COVID. But according to the article, like you mentioned, now at 97% occupancy, they basically had about 200,000 worth square feet of new leases over the last 18 months. I think the trajectory for this building is significantly brighter. And to your point, if the market conditions improve over the next 2 years, this is one of those loans that's a feel-good story. So it's good. You see a name like Tishman Speyer, you assume that they're going to get something figured out. But with numbers this big, sometimes it doesn't work. And so it's good to see this one get an extension in place, and hopefully, for the city and for the operator here, 24, 25 go on as they have over the last 18 months, and this property gets permanent refinanced at the end of the term.
So a couple more greens, and then we'll get to the crabgrasses. Here's another one that I love. This comes from WRAL in North Carolina. This just came out today. Apple is going to move ahead with their plans to build a new property in the Raleigh-Durham area of North Carolina. The construction, which will be about 325,000 square feet, should house about 3,000 workers. Why do I like this one so much? Well, we've seen Amazon pull the plug in Seattle. We've seen Amazon tap the brakes in the DC suburbs. Microsoft stop a project in Atlanta. Facebook stop development in New York. Great to see Apple not tap the brakes here and move forward with a project in that Research Triangle area. And in Detroit, again, this is one I really like. This is a story about a sale. This comes from Katie Sloan of Real Estate Business Online. The Herrick Company has acquired 2025 Woodward Avenue in Detroit for $150 million. This is a nearly 425,000 square foot office in Detroit. Why do I like this one so much? The bank is 100% occupied by Huntington. Huntington is on a triple net lease there. Normally, or maybe 6 months ago, we would say, okay, big tenant, big name tenant, locked in, triple net. Of course, this is going to be sellable. But given the turmoil we've seen in the banking world over the last 60 days, and the fact that Huntington was among many mid-sized banks that saw their stock drop 20 or 30%, the fact that somebody wants to buy this asset for a 9-figure price is a very happy story. And it's also Detroit, which continues to come back. Slowly but surely, that core of downtown Detroit continues to get a little bit bigger and bigger. And this is another sign of that Motown renaissance.
Yeah, I think that's a great story. It'd be interesting to know if they had to set aside any type of additional reserves at closing, or if they will, because of some of the turmoil that you've seen in the market and that you mentioned, Manus, for the single tenant exposure and the single tenant also being a bank. Generally speaking, in those types of environments, it's not uncommon to see a large reserve for, re-tenanting should they have to, or for some other protection should they not be able to pay the lease. And so, but yeah, great news. I think it's nice to have some good news and some green shoots in the office sector.
Moving to the crab, we'll run through these fairly quickly, but there is a lot of them. I thought the most interesting piece of the week came from Ellis Franco of the Charlotte Business Journal. She put out a lengthy piece which highlighted weakness in the Charlotte market. And to be honest, I really didn't understand the gravity of just how deep the space availability was in that particular market. We've written stories about Wells downsizing. We've written stories about B of A downsizing, moving. We know that there's been a lot of development there over the last decade, but her story was quite eye-opening, and it's worth a read if you can dig it up. If you need a link, certainly reach out to me or Haley, but it is behind a paywall. In it, the story highlights the fact that there are 10 very, very big offices in downtown Charlotte that have availability of 50% or more, which I thought was staggering. I never would have thought that. She followed that up with another piece, which maybe it's crabgrass, maybe it's mixed green. But she also reported this week that 2 Wells Fargo Center at 301 South Tryon Street in that same Charlotte market has been put up for sale by Wells Fargo. Wells Fargo did occupy about 850,000 square feet. They own the building. They are putting in the building on the sales block, probably at the worst possible time for this market. So, I don't want to predict what will happen here, but we saw what happened with Wells Fargo in San Francisco this week with a sale that was shockingly low in its value. This could be the kind of sale in Charlotte when people see it, and you've talked about this in the past, Lonnie, it's the kind of sale that resets the market. Right? You think of a market in terms of X dollars a square foot, and then something like this happens, and the whole rest of the market has to react to that new benchmark.
Yeah, especially in a market the size of Charlotte, you could really start to see things move with a couple of, high-profile buildings coming online and selling. And this, if hopefully it doesn't face the same fate as what we've seen with Wells Fargo out in the California markets, but to your point, not the best time to be bringing something, especially, 800,000+ square feet. And that single tenant exposure in the office market is a really daunting task to to convince people it's okay in today's marketplace. If I'm a buyer, when you have all these headwinds for the space generally, and then having single tenant exposure across almost 1 million square feet is just another, obstacle to overcome. So, well, I guess this will be something we keep on our radar, and we'll obviously inform our listeners as any type of transaction information gets announced, should they find a buyer for this asset.
You remember at the end of the Beatles, I guess you guys are probably too young for this, the last appearance they had together was on the roof of the Apple building. All right, they performed an impromptu concert in London on the roof of that. And I think that to pull together two stories about office and Taylor Swift, I think some of these office destinations or cities where they can't get people back to work at above a 50% threshold should invite Taylor Swift to start doing concerts on roofs of office buildings just to lure people into the office.
It's interesting you talk about that, because we had Ed Sheeran just outside our office this week on the Today Show. And there was a huge crowd there. In fact, I think we had a few Treppies that had made the trek out there like at 5 a.m. to get in line so they could see Ed Sheeran up close and personal. But, we hear about retail bringing in like this experiential component. Maybe the answer for all these office woes is bringing in some high-priced musical talent to get people back in the office.
A lot of meandering today, Haley, don't you think? I think we're just kind of all over the place. I think that haze this week has cut off, it's given me some oxygen deprivation. I think it's kind of leading me down this kind of Pink Floyd trek where I'm not really I'm kind of in the haze of, not being all there, but we'll see. Crabgrass, more crabgrass in the office. We referred to this a minute ago. This is from Laura Waxman of the San Francisco Business Times. Wells Fargo will sell 550 California Street for less than half of what it paid for the asset 20 years ago. They bought the asset for $108 million in 2005. This 350,000 square foot building is now expected to sell for about $45 million. If you're looking to convert that into square footage, it's $125, give or take, per square foot for that San Francisco market. In the sublease space in Chicago, Golub Capital put 75,000 square feet of space out at 150 South Wacker. Not an enormous amount of square footage. Why did this catch my attention? Because only recently was this loan underwritten, originated, and securitized. This particular loan, $100 million worth, found its way into two 2023 CMBS deals. And only a few months after the loan was made, one of the top tenants is looking to sublease space. In Austin, back to Lonnie's neck of the woods, Meta is looking to sublease 100,000 square feet at 300 West 6th. This is another kind of nick in that office market. Facebook previously decided to sublease 600,000 square feet of a building that was under development. This one is at 6th and Guadalupe. They were going to take occupancy. They changed their mind, and they will never take occupancy of that, and they will look to sublease that as well. So that continues the trend of big tech stocks pulling back. More of that in New York. This comes from the Real Deal as well. Microsoft looking to sublease about 40,000 square feet at 11 Times Square. That represents about 25% of their footprint in that particular story. And lastly, in Miami, law firm Kirkland and Ellis looking to sublease about 30,000 square feet at 830 Brickell in Miami. And that does it for the sublease. But I want to go to a different story, Lonnie, and I want to get your take on this. This needs more gray matter than I possess. So Globe Street put out a piece. It talked about markets where Class A occupancy was outpacing Class B and C by significant margins, and markets that the B and C was outpacing the Class A. So the markets where the A was doing really well, Charleston, South Carolina, Greenville, South Carolina, Nashville, Atlanta, and Charlotte. Those were the places where people are flocking to the Class A. Places where people are flocking to the B and C. And I'm going to ask you if you have any instincts for why one city may do better than another. So I'm going to give you a couple seconds to think about that while I rattle off the others. Places where B and C is outpassing A: Albuquerque, Columbia, South Carolina, San Antonio, Texas, Oklahoma City, and Kansas City, Missouri. Kind of an eclectic, widespread berth in that second group. You have any hot takes on why some cities might see the B's and C's outperforming the A's and others may not?
Yeah, so and for our listeners out there, this is a real Manus curveball. We have not talked about this prior to the show today, so I'm going strictly off the cuff here. But my initial reaction would be the cities where the A's are outperforming the B's and C's, probably tied to net in-migration, some corporate relocations, or new upstarts where maybe on the relocation side, somebody had an office for their headquarters in a larger city in a B or C building, and they could move to one of these better, lower cost of living places, pay less than they're paying for B and C rent in a Class A building, and so they make the move. That may have some impact on some of those. I would say most of those cities that you listed on both charts are kind of secondary, tertiary type of office markets, in my opinion. So, a large, what may be considered a large influx of net in-migration for those cities, on a relative basis, may not even scratch the surface in some of the larger cities. In terms of the B class cities, outperforming, like San Antonio as an example, it's interesting in Texas that, the San Antonio market from an office perspective is probably not nearly as nice or on the same level as, say, Dallas, Austin, Houston. So, if you were talking about this to a local broker, they would say San Antonio A, which would probably be the equivalent to like an A-, B+ type building in one of the major markets. I know USAA occupied a lot of the downtown Class A office space in San Antonio and recently moved those off-campus employees in those spaces back to their main campus. And so you've seen, I think the number was around 800,000 or 900,000 square foot of USAA leases that basically were bought out, and those properties became available basically all at once. So it makes sense in that particular market that maybe the B's and C's have outpaced the A's because they had such a huge influx of Class A space hit the market with no way to really absorb that at any type of a Class A market rent. Whereas the B and C markets were probably tighter on availability, and so they've been able to maintain or grow some of the rental growth, per square foot on those properties. So, that's an interesting perspective to kind of look at that. I think those other, the B markets that we're outpacing, if you look at the composition of tenants in those markets, my instincts would be, if we did some analysis, they probably would have a slightly different tenant mix in terms of who's occupying those spaces relative to the markets where the Class A is outperforming. I think we've seen kind of a bifurcation of certain financial services, tech, and others want the Class A high-end space, whereas you have other office tenants that are, looking for value, and they're willing to maybe go into a B or C space, which makes those markets competitive and maybe drives the price up.
So, Lonnie, I'm going to give you a chance to re-answer that next week. If you decide you want to come back and give additional thoughts once you pour through some of that Trepp data and scratch beneath the surface, we'll give you, you don't just get one curveball, you get 3 curveballs.
Okay, so let's turn to retail. We have a few stories that we were tracking this week.
Yeah, I got 3 sales here that are kind of a mixed bag. The first one is 4 grocery anchored shopping centers in the Richmond area in Virginia. The 4 shopping centers total about 600,000 square feet. They sold for $110 million. The story comes from the Richmond Biz Sense, and the reporter was Mike Platania. Hope I pronounced that correctly. The sale represents $185 a square foot, a nice uptick from 2019. These properties last sold for $98.5 million 4 years ago, so $110 million now, so 11% appreciation over 4 years. Another green shoot, this comes from the Mercury News. George Avalos, he's been referred to on the podcast several times in the past. Homestead Square Shopping Center, it's near the Apple offices in Cupertino, California, has sold for $92.5 million. That went to MetLife. They were the buyer. Seller was the Sobrato Family Foundation, a charitable organization. Tenants there include Safeway, Ross Dress, Michaels, Ulta Beauty, and Rite Aid. And this is kind of a mixed green. Stan Kroenke, who is the owner of the Rams, and the Nuggets and Arsenal, the UK Premier League soccer club. Stan must be Mr. Kroenke. I don't know how he likes to be referred, but he must be feeling pretty good with his Nuggets up 2-1 in the NBA Finals after last night's win. And he might feel even better because he bought the Malibu Village shopping center in Malibu for $81 million. That represents $1,600 a square foot, which may seem like a premium price to most. However, this property sold for about $120 million 10 years ago. So he's getting it for about a third less than what sold for a couple of years ago. So he's been a big buyer out there. He bought the Village in Woodland Hills for $325 million. That had previously been owned by Unibail Rodamco Westfield. And he also bought the Village in Woodland Hills for $175 million. One of those was going to be turned into a practice facility for the Rams. So a decent amount of activity in the retail space. We're seeing things trade, and certainly not at the velocity we saw in 2022, but things are happening, and things are happening at high prices.
Yeah, just to piggyback on the retail stories, man, did you see the Apple product announcement this week? The new Vision Pro, the 3D wearable mask camera. Or you think you're going to be making that purchase, and we might be seeing you on the podcast here with your Vision Pro and all of your notes just stored right there in front of your eyeballs?
You know, I just upticked from the rotary phone to the touchtone phone. So I think I'm a good 4 decades away from something that futuristic. I'm not a late adopter. I'm a virtually never adopter, of most things technologically. My kids will joke that they were the last kids on the block still rolling down their windows, with the crank. I think a car we bought in like 1997 still had the crank. And they look back with such chagrin.
So we finished property type news, but we did have some other Trepp reports this week. We just released our systemic bank risk report by our own Matt Anderson and Jeffrey. Lonnie, you want to run through some of our takeaways there?
Yeah, so for those that have been consuming the Trepp content for some time, this is a similar report to one we ran a few years ago that basically looks at data from the banking organization systemic risk reports, the FRY 15. This is basically a composition of the 36 largest bank holding companies. And so in this report, we go through, we do some analysis, we try to give some perspective on the interconnectedness of these exposures at the bank level. And the analysis shows, the importance of each bank, both at an aggregate and individual level. Analysis reveals entire group occupies a vital position within the U.S. economy, but a handful of firms stand out as having particular significance within the financial system. So there's this is one of those meaty research reports that we put out. So there's a lot of really good intel in there. As you guys have heard on the podcast, on our Market Pulse webinars, Matt Anderson and Jeffrey both work on our banking team and have become, recognized experts in the field. And so this is definitely worthy of their standards. And so if you'd like a copy of this, please reach out at podcast@trepp.com, and we'll be happy to send you a copy of the report. It's definitely something that'll give you some good takeaways after perusing the data.
Yeah, our bank team has been quite prolific lately, and for good reason. Ever since early March with Silicon Valley Bank, there's been heightened scrutiny on banks in general, bank data. Matt has been burning the midnight oil, so to speak, to get this research out and to comb through the data. We also put a piece out, which I think we're happy to share, Haley, which is what the playbook looked like for banks in 2008 to 2010, facing distress at that point, how they were dealing with stress testing, building default models, credit default models, dealing with the Dodd-Frank mandates and so forth, and how that playbook has changed over the last 10 years, and what practitioners of valuation, bank risk, stress testing, and so forth are doing right now to talk about what the impact might be for deposit flight, higher interest rates, lower interest rates, slowing loan growth, and or loan defaults and losses. So if that's your thing, bank risk, managing, whether it's from the bottom up, commercial real estate default risk, or from the top down, managing a bank's liquidity, this could be an interesting piece for you.
So let's turn to our programming notes for this week. Last week, we talked about some of our in-person events. So as a reminder, we will have teams in New York and in Barcelona next week at the CREFC annual conference and the Global ABS conference. But if you're not going to be in either of those places, we are also hosting a lot of virtual webinars for clients and non-clients. So a few that are coming up in the next few weeks, we'll be hosting a webinar for community banks. We'll be reviewing practical solutions for responding to regulator requests and stress testing and risk management information. That is on June 15th. We'll also be hosting our next Market Pulse webinar, which is open to anyone in the market, and we'll be covering the latest macro information and some data deep dives into CRE. That is on June 23rd. And then finally, for clients, we are hosting our next targeted training on the topic of identifying current office trends and the impact to valuation. And that will be on June 27th. So if you send us an email to podcast@trepp.com, we will share any of those registration links with you.
And if you're going to be at CREFC, I won't be in Barcelona, but I will be in New York for that event. Feel free to reach out to us and we will make some time to meet you at our booth or our hospitality room. And we're happy to talk about anything CRE, bank related, sports, music, or weather.
And I'll run through our shout outs quickly. John T has been a faithful listener for the past 2 years. He said the information we provide is timely and it's helped him in his career as a chief credit officer. Eric Y loves the podcast and has been a longtime listener. Chris T just started listening to the pod about 2 months ago, but he had to tell us that every time he has an opportunity to drive alone, he puts on the TreppWire pod, and sometimes he even listens to it over and over again to commit nuggets of info to memory. So thank you for that, Chris T. Jose V, who we hear from often, thanked us for the content. We heard from Mason F, who runs Multifamily Mason, and he listed our podcast as a resource for ongoing market updates and said it's the most data-packed podcast. So thank you, Mason. He was suggesting this to brokers out in the market. On Twitter, we heard from Mudge, who thanked us for our last episode and gave a hat tip to Ben Vandermeer, who we also gave a shout out to. Sharp on Sats recommended our podcast on Twitter. And Weiss Advice let us know that we actually got a shout out at the Prop Tech 360 conference in Tel Aviv last week. So that was very cool to hear. Robert K is interested in learning more about land development, so we'll be in touch with him and do some of that on our future podcast. And then a few more, we heard from Anson D, Nolan W, Matthew T, Byron R, William N, David V, Michael S, Sydney M, and Stephen L. So thank you all for reaching out. And before we close, I just wanted to call out to our listeners and to us that this is our 200th episode of the TreppWire Podcast. I don't know if you guys can believe that, but we just wanted to thank all of our listeners, some who have been here from the beginning and some who are just starting to tune in now. So thank you all for sticking with us every week. And as always, we really welcome any of your feedback, thoughts, questions, comments. You could always send us a note to podcast@trepp.com and we'll try to get back to you as soon as we can. So thank you to everyone for being a part of our Trepp family.
We're humbled by the listenership we get. I think we're close to 10,000 listens per week, which is about 20 times more than what we started out with. I think those early ones were just a couple of hundred people, and we've grown the audience. And a lot of that has to do with, first Keegan and being our first producer, and Haley getting our name out there, putting us out there on Twitter, circulating all our research reports and so forth. The great content that was Martha and Joe and Lonnie, that bring every week, which I think keep it very fresh and so forth. But I have to say the best part of it is the interaction we have with the audience, whether it's through Twitter or LinkedIn or email, phone call or over golf. I just feel like I've added another 50 or 60 friends over the last 3 years and 200 episodes that I didn't have before. And it's just, the spice of life, having people to talk to and joke around with and who know what you do. And it's, like I said, humbled and thankful for everything and every listener out there.
Yeah, this is definitely the highlight of our week, and we've said that multiple times. And I'm with Manus. It's, the interesting thing, I was doing a presentation this week while I was up in New York for a bank, and I walked in, I started talking, and immediately someone raised their hand and was like, it's so good to put a face to the name or to the voice, because I hear your voice on the podcast, but it's nice to meet you in person. And it seems like over the last 6, 9, 12 months, almost at every presentation I give or at every conference we go to, we get to meet 4 or 5 new people that have listened to us, and we get to shake their hand and get to know them a little bit. And to Manus's point, it's really great just adding to that Rolodex of friends in the the business, whether it be a lender or a practitioner on a brokerage side or capital markets provider. We love what we do. We really view this as, an opportunity for us to share a little bit about what we see. And we really appreciate the interaction we get from the listeners, because we get a little bit of your perspective mixed in with how we perceive things. And then that's our best, the best part, our favorite part of this so far. So let's keep it going. Hopefully we'll be talking to you guys here at episode 250, 300, 400.
And we're not going to rest until there's hundreds of bankers in wingtips chasing Lonnie down the street like the Beatles used to be chased back in the 60s.
They wouldn't have to chase me very far, because based on the shape I'm in right now, I'm not making it too far before I need to stop and catch my breath.
And hopefully the haze is cleared up by then. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening, and stay well.
All right.